Welcome to today's Explainer. We are diving into the market landscape for June 13th, 2026, and wow, the stakes are literally higher than ever. We've got a historic IPO that just totally drained market liquidity, a massive whale unleashing absolute chaos in the altcoin brackets, and the SEC unlocking a whole new level for institutional players. So let's get right into it. Here's a quick look at our battle bracket for today. First up, TradFi enters the arena. Then, the SpaceX gravity well. Third, Bitcoin and Ethereum diverge. Fourth, Ethereum's ultimate training arc. 5, the siren whale attack. And lastly, confronting the macro boss. Let's jump right into round 1.
Section 1. TradFi enters the arena with T. Rowe Price's active ETF.
Okay, so on June 12th, the SEC officially approved the T. Rowe Price Active Crypto ETF. Now, up until this point, institutional money has mostly relied on passive spot ETFs, the funds that just track a single asset. But this is a massive shift. We're talking professional active risk management. By dynamically selecting and balancing a diversified basket of assets, this fund is custom-built to attract conservative capital looking for real expert navigation when the markets get choppy.
So, what's on their roster? They've got a heavy-hitting lineup of eligible assets, including Bitcoin, Ether, Solana, XRP, and Avalanche. Typically, they're going to hold between 5 and 15 of these at any given time. Now, you might also notice USDC stablecoins in the mix, but actually, they're using those strictly as tokenized cash to cover expenses and make trading more efficient. It's not an investment vehicle for them.
Moving to Section 2, the SpaceX gravity well, also known as the $75 billion black hole. So, on June 12th, SpaceX launched a historic $75 billion IPO on the Nasdaq, and the demand was completely off the charts. It created this massive SpaceX effect, basically acting like a giant black hole that just sucked liquid capital right out of secondary risk-on markets, including crypto. The good news? As of June 13th, that capital flight has actually stabilized. But more importantly, this massive event is building a really fascinating new bridge between traditional equities and digital assets. To put that demand into perspective, just look at this number, $5.6 billion. That is the 24-hour trading volume of SpaceX perpetual futures on the Binance exchange alone. There's no way around it. That is massive. It's completely exploded to become Binance's second largest traded product, literally trailing only Bitcoin. Binance managed to capture over 60% of this market share, which just proves that crypto traders are incredibly hungry for these crossover TradFi assets. All right, Section 3. Bitcoin and Ethereum diverge, a tale of two heavyweights. It's a classic divergence. On one side, U.S. spot Bitcoin ETFs pulled in a super solid $85.9 million in net inflows on June 12th. This officially snaps a brutal, record-breaking 13-day outflow streak, and it was mostly BlackRock's IBIT fund doing the heavy lifting there. But on the exact same day, Ethereum spot ETFs saw $4.9 million in net outflows. They are just continuing this relentless bleeding trend. So what does this all mean? Well, when institutions finally decide to dip their toes back into the market after a period of extreme fear, they are very clearly choosing the relative safety of Bitcoin. And for Ethereum, these persistent outflows are incredibly dangerous. They risk becoming this self-reinforcing loop where shrinking fund sizes lead to lower liquidity, which leads to wider spreads, which then drives even more capital away. Next up, Section 4, Ethereum's ultimate training arc, building for the future.
Now, don't count Ethereum out just yet. To counter this market weakness, Ethereum is going through a literal training arc. It's a deliberate, multi-year strategy to scale the network. We saw Denkin in 2024, Pectra and Fusaka in 2025, and now we're looking ahead at major upgrades like Glamsterdam and Hackathon 2026. The goal here is to harden that core layer, step by step.
Let's zoom in on those Glamsterdam upgrades. These are bringing some serious power-ups, specifically focusing on enshrined proposer builder separation and block-level access lists. Basically, by mapping out interactions ahead of time, Ethereum can start processing transactions in parallel. So instead of doing things one step at a time, it can process simultaneously, which means way faster speeds and much more predictable costs when dealing with massive traffic. And they're looking even further ahead, too. The Ethereum Foundation researchers are already finalizing specifications to future-proof the network's cryptography against the ultimate final boss, quantum computing. So yeah, they are definitely building for the long haul. On to Section 5, the siren whale attack. Danger in the lower cap arena.
Down in the lower caps, things are getting wild. Just take a look at the Siren token supply. On-chain analysts found that a staggering 94% of the total token supply is controlled by whales. Let that sink in. Retail investors and everybody else make up just 6%. That is the absolute perfect setup for a market ambush.
And sure enough, the ambush happened. The token crashed a devastating 75%, plummeting down to just over 12 cents. How did that happen? Well, over just a 2-hour period, a single whale address dumped roughly 17 million tokens straight onto the market. When you have supply that concentrated, one single player taking profits can just completely decimate the price for literally everyone else.
And the panic didn't stop there. It infected the derivatives market too. Open interest dropped nearly 40%, down to $28 million, as panic traders rapidly unwound and fled their positions. It's a stark reminder that the lower cap arena is incredibly fragile when a whale decides to strike. This is exactly why retail traders retreat to major assets when the fear kicks in.
Which brings us to our final round, Section 6, Confronting the Macro Boss. Extreme Fear Ahead.
13. That is our current crypto fear and greed index score. 13 out of 100. That means the market is entirely gripped by a state of extreme fear. Even with the positive inflows to Bitcoin ETFs and the stabilization we saw after the SpaceX IPO, overall sentiment is just highly defensive right now. Absolutely no one wants to make a bold move.
And the reason why is pretty clear. Traders are staying completely sidelined ahead of the Federal Reserve meeting scheduled for June 16th and 17th. Now, interestingly, earlier in the week, we did get a flash of geopolitical relief when President Trump canceled those planned strikes on Iran. But while the market definitely welcomed the de-escalation, that relief just wasn't enough to trigger a sustained rally. Objective geopolitical good news is being entirely overshadowed by macroeconomic uncertainty. The Fed is absolutely the boss of the arena right now.
Just look at the CME FedWatch tool. There is a massive 96.4% probability that the Fed is going to leave interest rates completely unchanged to keep fighting global inflation. And as long as rates stay high, traditional cash yields stay super competitive, which restricts any speculative capital from flowing into crypto. Because of that, Bitcoin is just pinned. It's stuck in this narrow, range-bound channel right around $63,481.
So we've seen a whole lot today. We've got TradFi bringing active risk management to the top assets, massive equities like SpaceX pulling gravity on market liquidity, and retail traders getting completely crushed by centralized whales down in the lower caps. So I'm going to leave you with this final thought to chew on. With whales dominating the altcoins and massive institutions actively managing the majors, is the era of the retail crypto trader officially over? Thanks so much for joining me on today's Explainer, and I will catch you next time.